right, let's start with Delta. Delta had really good numbers, mostly due to their pricing power. There's pent-up demand there. People want to travel even more. We're in Florida. We're like, what do you mean? We've been traveling for, 18 months, but there's a lot of people out there that haven't been traveling, depending on where you live and what state you live in. And you're seeing that, which is like just amazing demand, which is coming out of this, which we saw in the numbers. But Daniel, what are your thoughts on this, and how do you feel about Delta quarter?
Overall, it was good. This is a great example of how there's a difference between the stock performance and reality. The premium segment, Delta, capacity is the big thing to look at. Hey, what was it compared to? How was your quarter compared to pre-pandemic, pre-coronavirus lockdowns, et cetera, et cetera? Capacity was around, they guided for the third quarter or second quarter, Frank. Capacity and revenues are going to be between 90 and 100, 93, 97% of the second quarter in 2019, excuse me. That makes a lot of sense. However, they're making up for it on premium seating, i.e. more expensive. Demand is built up. They're taking advantage of that. They have pricing power. We've talked about that a lot in the past for the environment we're going forward. My point to all that is this is a great stock. It's just a bummer, Frank, because the more money they make means what? The more we have to pay to travel. So this is how you get back. This is how you benefit and hopefully make some money, make a lot of money, because the risk reward is definitely in your favor. The CEO, I don't know if you caught the comments on the CEO on CNBC, Frank. Did you catch any of that this morning?
No, I wasn't able to catch that this morning. No.
This isn't a word for word, but he said, listen, we have pricing power. People are done remodeling their house and home. They want to fly somewhere to go look at somebody else's house and backyard. Cool. And that is a good point. Now, take that with a little salt. He's like all of us do. We're confident in our own. We're talking up our own book. He's obviously going to be bullish on airlines. However, when you see the prices moving higher, capacity is still going higher and everything else, that's a great sign for this in a turbulent market. Oh, nope, that's a terrible pun, Frank.
I'm going to be honest with you, because as you were, I'm looking at numbers and digging through this. And this is one of our holdings in our portfolio, in our CRA portfolio. And here's why everyone should buy the stock immediately right now. When I look at the numbers, Daniel, here's what I get. So in 2021, he had revenue of $29.9 billion, right? So that's COVID. Those are reflective of COVID. 2022, they're going to go to $44.8 billion. And then look out to 2024. This is about a little over $50 billion. When you look at EBITDA, we're looking at $2.2 billion this year, which is expected. They lost $2.6 billion last year. That's the COVID year. That's going to go to $5.5 billion in 2023 and $7.3 billion. All right, you're looking at a company where earnings are going to explode from $1.30 this year to $8.30 by 2024. Their PE ratio is 4 based on 2024. Next year's estimates is 7, and this company is growing and they have pricing power. And you have to keep in mind, this is why I love the name so much. And again, it's been tough, right? It's been a tough road and it's been crazy. But here's what's scary. COVID's mostly in the rearview mirror. Okay, mostly in the rearview mirror. And they reported these results with oil prices surging to 130 that quarter and are near 13-year highs. These guys are blowing out the numbers under some of the most difficult conditions. What do you think is going to happen when things ease? And even if the market does come down, you're going to see people reining in spending. They're still going to travel. People are still going to travel. They haven't traveled. Most people have not traveled still. They're still nervous to travel. And you're seeing that now, saying, hey, we're going to be profitable going forward, and that we are hitting numbers that were pre-pandemic. That, to me, that's amazing, because you're going to see a ton of demand for this name, and it's dirt cheap. So even if we're bearish going forward, at least I'm bearish going forward on the economy. Yes, we know the Fed's going to raise rates. There's a whole bunch of stuff going on. We know oil prices are high. They're reporting these results during extremely, extremely difficult conditions, meaning that they're great operational. And that's why I love Delta, because operational, they're one of the best. They know how to cut costs. They know how to figure things out. They know when things are bad, exactly what to do. And man, it's been one of the toughest environments, because you're not just looking at COVID. All right, everyone got impacted by COVID. But you're looking at, with Boeing planes and stuff and different orders because of their MAX, which was tough for the industry. Different strands, we saw COVID, different lockdowns in different areas. Now we have wars with shutting down certain areas. You're seeing, places like Europe and maybe those economies a little bit weaker. But the problems that they're dealing with, and to put up these numbers is absolutely incredible, because it's dirt cheap. It's reflecting that it's going to be a horrible environment for them. And they just showed, hey, if this is the horrible environment it's going to be in, we're kicking ass right now. And seeing these numbers and going forward and buying a stuff where earnings are going to explode, you can't really say that for everyone. I mean, you're looking at companies, you say, how do you forecast going forward? I mean, people are going to travel. I don't know if people are going to buy certain things, but you know that they're going to travel. All right? You could talk to all of your friends. You could talk to family members. You could figure that by yourself, how many people listen, we got to get out of here. We have travel. They have pricing power. massive pent-up demand, and COVID is mostly in the rearview mirror. And they showed that they could operate with super high oil prices, which I don't know if oil prices are going to stay at these levels, and maybe they come down a little bit more. We'll see, depending on Russia. And I know that war's getting even worse now. This week's supposed to be terrible as that war moves to the east. But Delta's numbers, man, holy cow, is that impressive. And my fault that I didn't get the pun because I was actually reading it and looking at that number going, holy shit, is this how much to actually, because I didn't look at 2024. I looked at 2023 and I was looking at 2024 and I was reading, I was like, holy shit. I was like, is that number right? And I just had to check it. But I mean, the numbers that these guys are, and listen, these numbers that I'm telling you are close to consensus, but they're Goldman Sachs numbers, and Goldman Sachs has a neutral rating on them. All right, so this is a fair assessment when you're looking at EBITDA going to $7.3 billion from $2.2 billion, right? From now till 2024, which is not that far away. Holy shit. It's hard to find numbers like that almost across the board. I mean, those are extreme growth numbers of an industry that's been really terrible and beat up, but these guys have pricing power. There's not a lot of competition in the space. People are going to fly, and these guys are great, especially when it comes to operations. All
right, so bullish on Delta. The only downside there or big headwind is if you go into a recession. But if you want to segue into JPMorgan, that's not going to worry about because Jamie Dimon, CEO of JPMorgan, says that he doesn't believe the U.S. will be in a recession this year. You say what? Now, he's talking, sorry, let me leave it to me to ask you a question and then not let you answer. He's probably talking, if we had to guess, about recession on paper, meaning back-to-back quarters of negative growth. Yeah. We'll give him that context. The takeaway there is he highlights, hey, the consumers are still in strong shape. Yes, you don't have as much money sloshing around in form of direct payments in governments as you did during the coronavirus. But he points to people, same thing with Delta, pent-up demand. People are willing to pay higher prices for things right now. Who knows how long this is going to last. But just like we talk about the spill in the river, it depends on how long it takes to get downriver, Frank. I was impressed with JPMorgan's numbers. I mean, they're a big bank. They're going to make tons of money off fees and everything else. They did a big buyback share repurchase program of $30 billion. But one thing that stuck out to me was a quick quote from Jamie Dimon. JPMorgan generated $30 billion in revenue, $8.3 billion in earnings, and a return on capital invested of 16%. Right outside of that, Frank, is damn good results. If you just spit that out of a machine that you want to invest money in, those are fantastic. That's along with putting aside an additional $902 million for credit reserves, largely due to higher probabilities of downside risk, i.e. Russia, inflation, things like that. Here you have a bank making a lot of money, putting money aside for higher credit losses going forward because of the risk, doesn't see a recession. Yes, it's going to be volatile, but the largest bank in the U.S. is telling you you don't have anything to worry about today, in my opinion. I'm not saying he's completely right. I'm just saying for the bulls out there and to be selective on stock picking, that's a good thing on consumer balance sheets remaining to be strong from their perspective.
Yeah, and
I wouldn't buy JPMorgan here. I'm not a big fan of them, but it's still good.
Yeah, I mean, that number is pretty big, and that's what everyone's talking about, the $900 billion that charge to build credit reserves. So if they're putting that much aside, you got to figure it's got to be around $250 billion, maybe $200 billion. They're always they're very, conservative. And I'm a big fan of Jamie Dimon. I think he speaks exactly from the heart. I don't agree with everything he says, but I think he's very truthful. One of the smartest guys that you'll see in banking and finance and stuff like that. Again, I don't agree with his point on Bitcoin and blockchain, even though he's in blockchain now and whatever. And, but when I look at these numbers, I think JPMorgan is a screaming buy for anyone who wants to hold this stock longer than 12 months. It's paying a 3% yield. It's great. The recession thing, I don't know. I mean, does it matter if we're in a recession 9 months from now or a year and a half from now? I know that we're going to be in a recession. I mean, if you don't think we're going to be in a recession, you need to see my briefing, which I published. It's going to be published later today for Curzio Research Advisory members. That's a product I think we sell for $79 a year, right? So, most of the people listening to this, I believe, own that product, but we just had a whole entire briefing showing of, all the data I'm seeing, the cracks of foundation I'm seeing over the past couple of weeks. And I shared that data with you, data that, I'm not hearing at all on TV or anything like that, but we are hearing about the rate hikes, of course, and that's going to be good for this company. We are hearing about trading revenue falling. Yes, we're going to see that, but we're all going to see unbelievable volatility, which is something Jamie Dimon said as well, where, he's like, anyone not expecting that is absolutely crazy. I mean, we have war, we have China, the lockdowns, we have, everything going on with interest rates going higher, the Fed going crazy, has no idea what they're doing right now. And nobody knows what they're going to do, right? We're all like, okay, they're going to raise, but, hopefully they do because they got to raise a lot. But when I look at JPMorgan's results here, they beat the numbers, and the headlines are like, well, profit was down 40% from last year. Okay. And they're talking about the credit reserves, which, they're being safe. And you got to build up credit reserves because interest rates are going higher. There's a lot of leverage out there. That's smart, right? So he's anticipating that, we had a good 12, 13. I mean, there's nothing. Nothing was going bankrupt. Almost nothing. I covered these statistics in past podcasts showing that, if you are bearish, and this was a year ago, I mean, you're seeing hardly any bankruptcies. You're seeing, companies paying their bills, everybody paying their bills. Again, people want to go crazy about debt. You have to worry about that when people stop paying it. Everybody's paying it, but it's going to get harder. And this is what I cover in that briefing. You can get 5 p.m. tonight if you're a CRA subscriber, but it's getting harder. It's going to get harder and harder as interest rates go higher. And that's one of the things that he's concerned about. However, with that said, if you're looking at these numbers, I mean, they beat the earnings, right? And they beat the earnings pretty handily, and that included 13-cent impact from Russia, which you're going to see during earnings season because everyone's like, we're not doing business with Russia. We're not, right, Dan? No, we're not doing business with It's going to hurt your freaking earnings, right? So some of these companies have leverage, right? So it's Paco companies, you have agriculture companies, you have leverage, right? So it's all nice to say, oh, you know what, we're not doing it, but it's going to show in your results. So a 13% charge for that, and the $900 billion charge for credit reserves. So with those two charges, they still beat earnings. Mm-hmm. He included that. A lot of people are saying, well, without that, this is what earnings were going to be. Right? So I cover earnings, you cover earnings, you see that a lot. Minus these charges, he put those charges in there and still beat estimates. So you're looking at a company right now that's trading at 3% yield. It's trading at 1.4 times tangible book value. That's how you value banks with tangible book value. To put that in perspective, that's where it was around 2017, and it hit that level several times, almost every single time from then, outside of like a 7-8 month period with COVID where, everything really came down, went back up. Every time it comes down to this level, it pops every time. So I know if you're a chartist, you're looking at this saying, holy shit, it's breaking down, it's going to go to 100, and I get it. And, they say that until the chart no longer works, where, money's going to filter into the good names. This is a good name that's getting it done. They're smart to put those reserves aside. It's a 3% yield. They're going to see an incredible boom to profitability when you're looking where interest rates are expected to go. And might hurt trading. And that's what we're seeing. You're seeing a lot of these investment banks with trading and maybe housing and stuff like that. But now you're looking at, they're going to make up the difference as interest rates go higher, which is more safer for them and most of these financials. But this is one of the names that you have to own in this crazy environment because it's a great play on inflation. It's better than keeping your money in the bank and you're losing money on the massive inflation. Now, at least you're getting paid 3% yield and a company that's going to benefit and their earnings is going to increase due to inflation. As they make that, that net interest margin is going to, get wider and wider, and they're going to make more money and margin is going to increase. But this is a name that I would be buying. Nice.
So you're, all right, buy Delta, buy JPMorgan. What about, are you ready to go into BlackRock and Larry Fink?
Yes. I mean, okay, you can start with BlackRock. These guys, I'm just going to say the one thing. You look at JPMorgan, Daniel, and they have a little less than $4 trillion in assets under management. And when you look at BlackRock, it's pushing $10 trillion in ETFs and assets. They had $9 trillion and last Q1, and this Q1 it's up to $9.6 trillion. Man, you want to talk about influence?
Yeah, absolutely. It's just wild. Taking a quote from Larry Fink, BlackRock generated $114 billion in long-term net inflows in the first quarter. Just in the first quarter, you have $114 billion in long-term net inflows. They talk about how it was positive across all product types, investment styles, and regions. This demonstrates the breadth in the asset management platform. Its electronic traded funds, ETFs, delivered $56 billion in net inflows as clients continue to use their products for efficient capital allocation, liquidity, and management risk. The big takeaway here is these guys make tons of money on fees. I'm not saying it's a bad business. It's a great business. The issue that I always poke fun at with Larry Fink and these asset managers is their influence and politicization of the economic forum and markets, Frank, because as you just alluded to, you can throw your weight around. And we've already talked about this with ExxonMobil. They got small minority holders of ExxonMobil ordered to the board because they have such voting power in all the shares that they hold, and they own massive shares as all this money comes into it. I wouldn't buy it here, but it's great business. I think
there's better businesses. I think there's much better business to buy.
Like the ones I think some of the banks, and also you mentioned too private equity, and this is one of the names that you're going to get in CRA because these guys are sitting on tons of dry powder. I did very, very well in KKR, and I think my investors did well in KKR. And this was when I recommended it after the credit crisis because when you're seeing tough times and businesses have trouble,
they have to turn to these guys, and these guys are great at dictate the terms, or the credit terms, and everything they want to do. And KKR is able to buy so much real estate that Europe and the U.S. and even Europe, more to the point, was forced to sell, right, to reduce their exposure to some of these assets, right, to increase their ratios when all these regulations took place 2008, 2009, and they were getting stuff at pennies on the dollar, right? Why? Because they were the only people that had tons of money. I mean, the one that we're recommending has, I think, it's over $80 billion in dry powder. A lot of these guys, $80 billion in dry powder out of their $300 billion in assets under management. These are the companies you want to own, because as it comes down, these are the guys that can pick and choose and say, okay, well, here, we're going to get this credit. We're going to get it for nothing. We'll be behind you. But the terms that they dictate and the position that they're in, when you have this kind of cash, you are king in tough markets. And that's what I think everyone's expecting going forward. So when I look at BlackRock, is it, if you own it, I wouldn't sell it. That's fine. But I just think the JPMorgans are better. I love the private equity firms better if you're looking at finance, within finance, and those are better. And I just want to say this one thing, because I know you've been on private equity, but I want to say one more thing about BlackRock. Do you think it's fair, Daniel? Because the influence they have is, and most of you out there are part of BlackRock, right? If you're in the 401ks and ETFs and things like that, and a lot of this is retirement money, right? This is retirement money. So, you're checking a box and saying, okay, I want this. And then they go and buy, and you're in BlackRock. So now you have all these people in BlackRock, and now, you build up to $9 trillion assets. And literally BlackRock, I want to say, is in every single stock that you'll find. Almost every single stock that has a market cap above, say, 250 million, you're probably going to see BlackRock's name there. You're going to see Vanguard's name there. You're going to see Fidelity's name there, right? So they're managing other people's money with all those opinions and stuff like that. But now they're able to have this mass, pull them all together, and it's BlackRock that's speaking. And they can get behind climate change like they did with Exxon and said, hey, we're voting. We're going to get these guys on the board, and they can do whatever because they have massive voting power. And that's what you're seeing right now with a lot of companies. I think Shopify did this as well, where, he wants more power. Again, the whole world revolves around power, right? I'm reading Animal Farm with my daughter. Holy shit. I haven't read in a long time, but man, you can see what's going on right now when it comes to power, right? How things change. You tell everyone things are going to be different this time. And then as you go along, you see that person who's in charge is trying to get as much power as they can. And that's what they're doing. BlackRock is just a very powerful company. But do you think it's fair? Because they're able to have one opinion because they're BlackRock. Yet everyone who's in their funds, and sometimes you're forced to be in their funds, depending on what company you have, what 401k plan you have. But now they're able to push their weight around to get their agenda. And I have to be honest with you, that agenda is, from what I see with BlackRock and a lot of these firms, is a lot of it has to do with woke culture, which is pretty crazy. So is it fair? I don't know if it matters if it's fair, but how you pool everyone's money who, have different opinions. And even if you were if BlackRock is super conservative and doing it, I would say the same thing. It's just, to me, that's a problem there. That's a major problem because these guys have massive control, and it's the control because they're having all this control over people's money, and they're not really representing their opinions, I think.